U.S. markets surged after 2010, but rising global government debt and long-term bond yields are bringing 1965 back into focus. 1965 provides a stress testing framework for portfolios facing a simultaneous shift in debt, inflation, and interest rate regimes. The International Monetary Fund estimates global public debt reached nearly 94% of world GDP in 2025, projecting it will hit 100% by 2029. Major economies are driving this increase by expanding expenditures in social programs, defense, and debt service. The OECD projects gross government borrowing will approach a record $18 trillion in 2026. Governments are now forced to refinance their older, low-coupon debt at much higher market rates. Look at the steepening yield curves. U.S. 10-year and 30-year yields are sitting elevated, between 4.7% and 5.2%. The central challenge is a rare structural environment where both the sheer volume of borrowing and the cost of borrowing are elevated at the exact same time. At the start of 1965, inflation was hovering near 1%. It escalated rapidly as expanding fiscal demands from Great Society programs and the Vietnam War strained the federal budget. Facing political pressure to avoid disrupting Treasury financing, the Federal Reserve maintained accommodative policies. By 1980, inflation would exceed 14%. The modern environment has critical differences. Today, central banks operate with explicit inflation objectives, and currencies float freely rather than operating under the Bretton Woods system. At the same time, public debt ratios are now much higher, populations are older, and the scale of required debt refinancing dwarfs the needs of the mid-1960s. To test how a modern portfolio might react, we can use the Jordà Schularick Taylor Macrohistory database, which tracks long-run total returns across 17 advanced economies. 1965 isolates a specific risk. How conventional portfolios built during periods of financial success hold up when debt and interest rate regimes abruptly shift? Imagine two investors reviewing the prosperous 15-year run of domestic financial assets from 1950 through 1964. Investor 1 builds Portfolio A, 80% U.S. equities and 20% long bonds. Investor 2 builds Portfolio B, keeping a 50% U.S. equity base, spreading 30% across the UK, Japan, and Australia, and dividing the remaining 20% equally between long bonds and short-term Treasury bills. This incorporates large developed markets abroad, introducing different economic cycles to the overall holding. Over the next 18 years, these two portfolios test recency bias against geographic and duration diversification across a major inflationary period. This line chart tracks the nominal results between 1965 and 1982. Both portfolios accumulated substantially more dollars from a starting investment of $100. Portfolio B finished ahead. It reached $483.46, about 51% higher than Portfolio A's $318.83, and achieved this with slightly lower annual volatility. Between 1965 and 1982, the U.S. Consumer Price Index nearly tripled, silently acting as a tax on wealth. When we adjust this chart for price level changes, Portfolio A's $318 flattens out, representing just $109 in 1965 purchasing power. Completing the adjustment on Portfolio B demonstrates a distinct gap, as it successfully retained $165 in real purchasing power. A direct comparison of the resulting real compound annual growth rate shows Portfolio A at only 0.48% against a much stronger 2.83% for Portfolio B. Increasing balances on a statement provide an illusion of success that completely masks a portfolio's failure to protect a family's actual standard of living. Diversification did not prevent losses. During the 1974 market crash, both portfolios suffered severe real drawdowns of nearly 40%. Portfolio B survived the long term because its international equity markets had return cycles that were not perfectly synced with the United States. Allocating to short-term Treasury bills allowed half of its fixed income sleeve to reset rapidly as short-term interest rates rose, avoiding the severe vulnerability of long-duration nominal bonds. The 1965 experiment illustrates how geographic and duration diversification preserve wealth during a regime shift. Portfolios optimized backward, based entirely on recent asset performance, often contain hidden macroeconomic concentrations that fail when regimes shift. Historical analogies cannot predict exact market outcomes. However, they demonstrate that structural diversification across geography and duration protects wealth against risks we wrongly assume will never change.